All right, welcome to The Explainer. So today we're digging into a real head-scratcher from the market. What happens when a company comes out with fantastic news and its stock just gets totally hammered? Well, that's exactly what happened in the very strange case of Monday.com.
So let's set the scene. Think of this as the scene of the crime. On November 10th, Monday.com stock didn't just take a little dip. No, it absolutely fell off a cliff. We're talking a drop of nearly 17% in a single day. That kind of move just wiped out billions in market value. Poof, gone.
And that, right there, brings us to the central paradox. The big question that honestly baffles investors all the time. Why on earth would a company that just crushed it, that did everything right, see its stock get punished so severely in return? It just doesn't seem to make sense, right? Okay, let's investigate.
Okay, first up, let's look at what I'm going to call the evidence for innocence. This is all the stuff, all the data that screamed the stock should have soared, not crashed.
I mean, just look at these numbers. The company reported phenomenal results for Q3. Revenue, it came in $4.5 million above what Wall Street was expecting. Adjusted earnings per share, that key profitability number? A massive 32% higher than anyone thought. And operating income blew past estimates by 34%. Seriously, by any measure, this wasn't just good. It was an absolute blowout.
And to put that into perspective for you, this performance was fueled by 26% year-over-year revenue growth. I mean, that is incredibly strong, especially in what's been a pretty tough environment for a lot of software companies out there. So, by all the normal rules of the game, this report was a total home run.
Okay, so if the past was so bright, what gives? What about the future? Clearly, the market's reaction tells us it found something wrong, a flaw in the story. So let's uncover the smoking gun, the clue that sent investors just running for the exits.
And here it is. This is the heart of the conflict. The market, it just completely ignored that $4.5 million beat for the quarter they just finished. Instead, it zeroed in, completely fixated on a projected miss of about $4.8 million for the quarter that's coming up. It's like, what have you done for me lately got thrown out the window and replaced with, what are you going to do for me tomorrow?
So get this. The really crucial point here is that a multi-billion-dollar drop in the company's value was triggered by this tiny guidance shortfall. We're talking just 1.4% below what analysts were hoping for. That's it. That's the smoking gun. It's practically a rounding error in the grand scheme of things, and it caused an absolute panic.
But you have to ask, right? Was this guidance really a sign of weakness? Or was it maybe part of a bigger, deliberate strategy? To figure that out, we really have to listen to what the company's own management had to say about it.
So the CFO, Aliran Glazer, he jumped right on this. He directly addressed why they were being a bit cautious with their outlook. And he explained, look, this isn't about the business failing. It's about a strategic pivot. They're deliberately shifting their investments toward what he called ROI areas, return on investment, things that promise much higher profits down the road, even if it takes a little longer to get there. And then the Chief Revenue Officer, Casey George, he kind of filled in the blanks for us. He gave us the specifics. So what are these high ROI areas? Well, they're the big fish, the massive enterprise clients. See, Monday.com is successfully moving upmarket, landing these huge customers. But, and this is the key part, bigger deals just naturally take more time to close. The sales cycles are longer. So that slightly lower guidance, it's really just a reflection of this smart strategic shift, not some fundamental problem with the business.
So all of this, it brings us to the great debate, the question that started flying around right after the stock plunged. Was this a massive red flag, a warning sign telling everyone to get out, or was this a golden opportunity to buy?
Let's break it down into the two camps, the bull case versus the bear case. You've got the bulls, the optimists, saying, hey, this is a classic overreaction. And then you've got the bears, the pessimists, saying, nope, this sell-off was totally warranted. Okay. Let's start with the bull case, the argument for why this is a huge opportunity. The bulls are pointing to some incredibly strong numbers under the hood. For instance, net dollar retention is at 115%. Now, what that means is that their existing customers are actually spending 15% more this year than last year. That's a super healthy sign. Plus, their new products like their CRM tool are really starting to take off. And hey, after the big drop, the stock is just cheaper. Its valuation is lower now, which for bulls suggests it's a much better price.
But then you've got the bears, and they see some serious red flags. They're worried that revenue growth is slowing down into the low 20s.
And for a stock that's valued as highly as Monday.com was, any sign of a slowdown can get punished, and punished hard. They're also looking at the bigger picture, broader threats like AI. Think about it. Monday.com's whole model is based on companies paying per seat, or per user. If AI starts automating a bunch of tasks, maybe companies won't need as many seats, and that could really hit revenue.
So, how do we reconcile these two totally different views? What's the verdict here? Where do we land?
You know, when you boil it all down, this whole thing is really a classic Wall Street story. It's a fight between a company's proven, stellar execution, what they've already done, and the market's deep-seated anxiety about even the slightest bit of uncertainty about the future. Monday.com did everything right. They executed brilliantly, and the market punished them because the future was maybe 1.4% less certain than it had hoped for. And that really leaves us with one last big question. Is the market's obsession with these tiny, short-term guidance numbers causing it to miss the forest for the trees? Is it so focused on the next 3 months that it's failing to see a really healthy company making a smart strategic shift for the long term? It's a great question to keep in your back pocket, especially the next time you see a good company stock get crushed on what looks for all the world like great news.